The data on savings accounts says one thing. What is actually happening to your money says something completely different. Here is the number nobody is showing you. The average high-yield savings account in America right now pays around 4.5% annually. Sounds decent, right? But the 10-year average inflation rate sits at 3.8%, and in 2022 alone, inflation hit 8.3%. Do the math. In a real inflation, imagine you are 28 years old. You have got $10,000 saved, real money. You worked hard for it, and right now you are standing at a fork in the road. Two paths. Both look reasonable from where you are standing. Path A is the one most people take. It feels responsible. It feels mature. It is what your bank is quietly hoping you choose. Path B looks a little scarier from the outside. It requires you to learn something new. It asks you to think differently than the generation before you. But here is what is wild. The gap between where Path A ends and where Path B ends is not small. We are not talking about a 10 or 20% difference in outcome. We are talking about the difference between working until 67 and having genuine financial freedom in your 50s, or earlier. The fork is real. The choice is yours. And the uncomfortable truth is that most people never even realize they made a choice at all. They just defaulted. Let us make sure you do not do that. Path A looks like this. You open a savings account at your local bank. Maybe you even shop around and find a so-called high-yield savings account online. You set up automatic transfers. You watch the balance grow. It feels safe. It feels smart. Maybe you also put money into a CD, a certificate of deposit, locking it up for 12 to 24 months for a slightly better rate. Or maybe you go old school and buy U.S. savings bonds. Your grandmother swore by them. And look, none of these things are evil. They have a place. But here is the brutal reality of Path A. The national average savings account rate at traditional banks as of late 2024 is still hovering around 0.45% annually, not 4.5, 0.45. That means on $10,000 you are making $45 a year. Meanwhile, groceries are up, rent is up, gas is up, insurance is up. Your $45 is not fighting inflation. It is not even showing up to the fight. And the people who stay on Path A for 20 or 30 years? They look up one day and realize their purchasing power has been quietly gutted. They saved faithfully and still fell behind. That is the trap. It does not feel dangerous. That is exactly why it is dangerous. Let us run the actual numbers because this is where it gets uncomfortable. You invest $10,000 in a savings account earning 0.45% annually for 30 years. After 3 decades, you have approximately $11,440. That is your reward for 30 years of patience and discipline. $11,000. Now factor in cumulative inflation over that same 30-year window. Historically, inflation averages between 3 and 4% per year. At just 3% inflation, that original $10,000 would need to be worth about $24,270 just to have the same purchasing power it had on day one. So your account shows $11,440. But in real terms, in what you can actually buy with that money, you have lost nearly half your wealth. This is not a fringe scenario. This is what has happened to millions of Americans who followed the conventional advice. They did everything right by the old playbook. They saved, they were disciplined, they avoided risk, and they still got poorer in real terms. Path A does not just stall your financial growth. Over time, it reverses it. And the worst part? You will not feel it happening until it is already done. Now let us talk about Path B. Same $10,000, same 30 years, different decision. Instead of a savings account, you put that money into a broad market index fund. Specifically, something tracking the S&P 500. The S&P 500 is not a single stock. It is a basket of the 500 largest U.S. companies. Apple, Microsoft, Amazon, Nvidia. When they grow, you grow. The historical average annual return of the S&P 500 since 1957 is approximately 10.7%. Not every year. Some years it drops. 2008 was brutal. 2022 was rough. But over 30 years, the average holds. So what happens to your $10,000 on Path B? After 30 years at a 10% average annual return, you are looking at roughly $174,000. Not $11,440, not $24,000, $174,000 from one $10,000 decision made at 28. That is the power of compound growth. Warren Buffett has called compound interest the eighth wonder of the world. He is not being poetic, he is being mathematical. And here is the thing that changes the entire game. You do not need to be rich to get started on Path B anymore. You do not need $10,000. You do not need a stockbroker or a Wall Street connection. The barrier to entry has been obliterated. Let us take Path B further, because $10,000 once is a starting point, not a strategy. What if you invested $300 a month, roughly $10 a day, into an S&P 500 index fund starting at age 28? At an average 10% annual return, by age 58 you would have approximately $678,000. By 65, you are pushing past $1.3 million. That is from $10 a day, the price of 2 coffees. Now compare that to the Path A version of that same $300 monthly contribution into a 0.45% savings account for 30 years. You would have around $109,000. The gap is not double. It is not triple. It is 6 times. This is why financial independence is not about income level. It is about which path your money is traveling. High earners on Path A still run out of money. Modest earners on Path B build generational wealth. And the difference between the two paths is not luck. It is not timing the market. It is not being born into money. It is understanding that the so-called safe choice is actually the high-risk choice when you account for time. Real risk is not volatility. Real risk is arriving at... So how do you actually choose Path B practically? Because knowing is one thing, doing is another. First, understand what you actually need savings accounts for. They are not useless. They are the right tool for one specific job, your emergency fund. 3 to 6 months of living expenses, liquid, accessible, safe. That money belongs in a high-yield savings account, full stop. Beyond that emergency cushion, every extra dollar you are parking in savings long-term is working against you. Second, stop waiting to feel ready. There is no version of this where the market feels completely safe and comfortable and obvious. In 2009, the market looked terrifying. People who got in made extraordinary returns. Here is the first step, and it is simpler than you think. You need a brokerage account. And right now, there are apps designed specifically to remove every excuse that used to stop people from investing. We are talking no account minimums, commission-free trades, and fractional shares, meaning you can own a piece of Apple or Amazon for as little as $1. No joke. Apps like Fidelity, Charles Schwab, or newer platforms built around index fund investing and fractional shares have genuinely democratized this. You do not need thousands of dollars to start. You need your phone in about 10 minutes. Search for an app that offers low-cost index funds. Specifically, look for funds with expense ratios under 0.10%. That means you keep 99.9 cents of every dollar working for you instead of paying it in management fees. Set up automatic monthly contributions, even $50, even $25. The habit matters more than the amount in the beginning. Automate it so you never have to make the decision again. Because the biggest threat to your financial future is not the market crashing. It is you talking yourself out of starting. You have seen the numbers today. You know what Path A actually costs you. The question is not whether you can afford to invest. After what you just saw, the real question is whether you can afford not to. If this video changed how you think about your money, hit that like button right now. It genuinely helps this channel reach people who need to hear this. Subscribe if you want more straightforward financial content with zero fluff and zero jargon. And drop a comment below telling me, which path has your money been on? I read every single one. The next video is going to break down exactly how to set up your first index fund investment from scratch, step by step, in under 15 minutes. You do not want to miss that one. Disclaimer: this video is for educational purposes only. Nothing constitutes financial advice. Always consult a licensed financial advisor.